Most people pick their mortgage rate type the same way they pick a restaurant. They go with whatever sounds familiar and hope it works out. That's how people end up overpaying by tens of thousands of dollars on a loan they'll carry the next 30 years. Today, I'm going to show you exactly how a fixed rate mortgage and an adjustable rate mortgage actually work, with real numbers, so you can make this decision based on what makes sense for your situation, not just what your neighbor did. Let's get into it. When you take out a mortgage, the interest rate on that loan can work in one of two ways. Option 1. It stays the same for the entire life of the loan. That's a fixed rate mortgage. The rate you sign on day 1 is the rate you'll have on payment number 360. It never moves. Option 2. It starts at one rate and then adjusts up or down at defined intervals based on market conditions. That's an adjustable rate mortgage, or ARM. Both are legitimate products. Both are used by real buyers every single day. The question isn't which one is better, it's which one fits your timeline, your risk tolerance, and your financial plan. That's what we're going to figure out today. A fixed rate mortgage is exactly what it sounds like. The lender and the borrower agree on an interest rate at closing, and that rate is locked in for the full loan term, typically 15 or 30 years. The primary benefit is predictability. Your principal and interest payment will be the same in year 1 as it is in year 29. That makes budgeting straightforward because you always know what's coming. The trade-off is that fixed rates are almost always priced higher at the start than the adjustable rate mortgages. Lenders are taking on interest rate risk on your behalf for the full term of that loan, and they price that into the rate. You're paying a premium for stability. And depending on your situation, that premium is absolutely worth it. Fixed rates tend to work best for buyers who plan to stay in a home long term, who value payment consistency above all else, or who are buying in a lower rate environment and want to lock in those rates permanently. An adjustable rate mortgage starts with a fixed introductory period, usually 5, 7, or 10 years. During this time, your rate will not change. After that window closes, the rate adjusts on a set schedule, usually once per year. You'll see these written as a 5-1 ARM or a 7-1 ARM. The first number is how many years the rate is fixed. The second number is how often it adjusts after that. So a 5-1 ARM gives you 5 years at a fixed rate, then adjusts once per year going forward. Now, how does that adjustment actually work? ARMs are tied to a benchmark index. Today, that's usually the SOFR rate, the Secured Overnight Financing Rate. When that index moves, your rate will move with it, but within limits. ARMs come with rate caps that protect you from runaway increases. Here are the caps that you should know. The initial cap. The maximum your rate can increase at the very first adjustment, often 2%. The periodic cap. The maximum it can increase at any single adjustment after that, also often 2%. And the lifetime cap, the absolute ceiling. Your rate can never exceed this amount above your starting rate, often 5%. So if you started at 5.5%, your rate could never go above 10.5% over the life of the loan, no matter what the market does. The main appeal of an ARM is that lower starting rate. And the lower rate means a lower monthly payment during that fixed period, which can be significant. Let's put some real numbers on that now. Assume you're buying a home, and your loan amount after your down payment is $350,000. On a 30-year fixed rate at 6.75%, your principal and interest payment comes out to approximately $2,270 per month. On a 5-1 ARM, starting at 5.5%, that same loan produces a payment of approximately $1,987 per month during the initial fixed period. That's a difference of over $283 per month. Over the 5-year period of the ARM, that adds up to $16,980 in savings. Now here's where the decision gets real. If you sell or refinance before that ARM adjusts, which a significant portion of homeowners do, you captured nearly $17,000 in interest savings and face zero rate risk. That's a strong outcome. But If you stay in that home and rates climb, your payment will increase. At the first adjustment, if the rate moves up by the maximum allowed of 2%, you're now at 7.5%. That same $350,000 loan is now closer to $2,450 per month, which is higher than the fixed rate payment you passed on in the first place. This is why the ARM conversation is really a timeline conversation. The math works in your favor when your expected stay is shorter than your fixed period. The math works against you when you stay long enough to absorb multiple rate increases. Here's a straightforward framework for making this call. You should choose a fixed rate mortgage if you plan to stay in this home for more than 7 to 10 years, you're buying in a lower rate environment and want to lock it in, payment consistency matters to your household budget, you're risk averse and you don't want to think about this again. On the other hand, you should consider an ARM if you have a clear, realistic plan to sell or refinance within the fixed period, a job relocation, a known upgrade purchase, a defined financial milestone. The rate savings are meaningful and you'll put that money to work. You understand the cap structure and are comfortable with the worst case scenario. Or you're financially flexible enough to absorb a payment increase without disruption. One thing we should be very direct about. An ARM is not a product to choose because you need a lower payment just to qualify. If the only reason the ARM looks attractive is because the fixed payment doesn't fit your budget, that's the loan telling you something worth listening to. Use the ARM as a strategic tool, not a qualification workaround. So here's what we've covered today. A fixed rate mortgage gives you a locked rate for the life of the loan. Higher up front, maximum stability. An ARM gives you a lower rate for a defined initial period, then adjusts annually. Lower up front, but more moving parts after that fixed window closes. On a $350,000 loan, the difference between a 6.75% fixed and a 5.5% ARM is about $283 per month, which adds up to nearly $17,000 over 5 years. Whether that works in your favor depends entirely on how long you stay. Neither product is the right answer for everyone. The right answer is the one that lines up with your timeline, your budget, and your plan. If this video helped clarify something that felt confusing before, that's exactly what this channel is built to do. Next up, we're going to cover closing costs, what they are, who pays them, and how to negotiate them so you're not caught off guard at the closing table. That video will be linked here once it's created. If you found this one useful, subscribe so you don't miss it. No fluff, no filler, just the information you need to walk into this process knowing what you're doing. I'll see you in the next one.